listening into your audio, it was perfect. You could tell when someone didn't have their mic on just because I know the difference, but if
They
you
could
didn't,
still- but Dwayne couldn't hear well if Norwood wasn't, even though he's got a boomy voice, Dwayne was going like this.
you probably need
Thank you.
speakers.
Could be. All right, so now I have to open.
Because this is what's catching your eye. Yeah, break it. That's cool, Sonny. So this is what's catching your audio.
3:30.
See how quick I can be.
All right.
You have that look in his eye. I don't know what to tell you. I think he likes to be timed for stuff.
Yeah.
Did Norwood give you his slip back?
Slip? No, he didn't. No, that's a new pencil.
Well, I was trusting him to give it back to me.
Let me see if I picked it up. This is all the new stuff. This is the old stuff I collected off the desks.
Oh, well, worst case scenario, I'm gonna back some of the next. Then just order the zip line. Yeah, you were doing that. You probably wanted to read it.
Oh, and yeah, because this is all, yeah.
Okay. I'm catching up. He's on the zip back to me. So I'll see him. Tomorrow morning, so.
Oh, so you need to put that one as well.
No, I'm just saying I'll see him when I can find one. You're like, you have to read it outside.
All right.
Somewheres.
Now, I go back over here and I hit share, right?
Mhm.
Oh, I drag these all over first. Do I drag these all these things over first, or do I? hit
Yeah.
share?
It's probably easier.
Right.
Having fun yet?
Yeah. Yeah, this is my first time here, but this is my favorite part of the job. It's getting to go and see our clients and present to them. Fortunately, we made money this quarter, so.
So you don't feel quite as bad.
In the past few quarters, yeah.
Have you gotten to drive around Palatka, go to lunch or anything?
I did, so I got here super early.
Yeah, I'm.
Yeah, so I actually went to the Black Coffee Company. I went and hung out there for a little while and then drove around. So.
The newer place in town.
Mhm.
Sorry, I heard the front door, but middle east. I'll see funny.
Okay.
Yeah, I was gonna stop and get lunch, but I usually wait till after meetings.
Gotcha.
But someone recommended, trying to remember who, Nico's.
Oh, yeah.
Mhm.
So I was considering stopping there, so.
My favorite dish from there is the hero.
Oh, really?
Because Nico's is traditionally a Greek place, even though they sell a lot of Italian food.
Okay.
So I get the hero.
My husband likes the lasagna, and I like the ravioli. All good.
This is why the fucking stuff is prominent on the menu.
But it's all good.
Yeah, yeah. I've gotten their pizzas before.
Greek salad,
Mhm.
really good Greek salad.
Kicking myself, I should have gone.
You can go on the way out of town.
That's true. That's true. I'll make my report pretty quick so I can stop.
So you can beat the dinner rush, okay?
Yeah, I love the historic buildings. It's again, it's one of the fun parts of our job. We work for so many municipalities that we get to see, from South Florida to the Panhandle, all the different cities, big and small. It's cool that they'll have their own character.
Yeah, yeah. We, our building was built in 1915 and it was the post office at the time.
Okay.
Not that you can really tell it from the lobby because they've done a lot of remodeling out there, but you can actually see where the original commission room, this wall wasn't here. It went out through the little cubby hole that you may have noticed by the TV. It says commission room.
Mhm.
So people came in through there.
Okay.
Somewhere we've got a picture of the 1960s of what it looked like in the commission chambers, and you can see it's bigger. But of course, they closed it out over time and they've like a little lobby area and a couple of little offices, but
Still cramped.
they're so cramped. And now the commission chambers is cramped because during commission meetings, we get full in here
Mhm.
easily.
Yeah.
So we're definitely outgrowing the space.
Is the city itself growing a lot? Do you see a lot of people migrating to Palatka.
Starting.
We've had more annexations within the last year than I think we've done in the last 10 years.
Mhm.
So it's pretty, definitely growing as far as, planning standpoint.
Planning standpoint.
I
yeah.
think from, my planning director, I think at the last city commission meeting, I think she said that they've handled over 400 cases, touched over 400 cases last year, but that includes plans for buildings,
Mhm.
you know, everything that they've touched, but still. For Palatka, that was quite an accomplishment.
Yeah.
Yeah,
And their department has grown from 1 to 3,
okay.
so. And that's considering we've outsourced building permitting to the county.
Mhm.
So that's literally plans examining, business tax, just outside of it, so, yeah.
Yeah, it's, we're in Orlando. We work with a lot of people like on the outskirts of Orlando, like Lake County, and it's incredible how much expansion has gone, like Claremont and Davenport, and Lake Wales. Every time I drive out, there's like new multifamily apartment complexes and new neighborhoods going up, and it just, every single time it surprises me.
I know I can't tell where one of those towns ends and the next one begins personally.
Yeah,
When I say that to the clerk, I know some of the clerks in that area, when I tell them that, they look at me like I'm crazy, but I'm like, in Florida, you know, there's like woods and a little bit.
Yeah.
That's, you know, it's like calm down, you know.
right on top of each other.
How you doing? Still here. You don't have extra copies or you got them up there?
I got them up there.
Good. Yeah, one day I'll get my computer back. People that's got it.
Well, you know, and
I think I
yeah, you're gonna be required to have a city of Palatka email address. To be
Okay.
on boards. It's a state requirement, you know, that you have a,
Who issues those? I get to put it in there.
not, yeah.
She'll get me one.
Sunny's has it all set up for you. She's gonna give you paperwork to sign to say,
All right,
yeah, how to access it and what your password is.
sure.
But you'll still need a computer to get there.
I'm sorry.
You'll need the computer to get there though. You know,
Well, I got a computer that works, but I don't have it. I can't get my emails. The dadgum, AT&T started monkeying around with it, changing stuff.
Mhm.
I've never been able to get it back. But if I got one new one here,
Yeah, you got a new one. Okay, so if you would, my city attorney make a little do's and don'ts of your email. If you would sign that, I'll give you your username and password.
A working pen? Sure, that's a working one.
You know, attorneys, it's just don't commit fraud, don't, you know, the standard.
You know, even though Brett isn't here,
Mhm.
he can still be reappointed, can't he? Ah, okay. so
Yeah,
we
you
can do
need,
that.
a motion to appoint him. And then I've already put a placeholder on the commission agenda to ratify the appointment, his appointment, because code says that the fifth member, although they appoint, the commission has a ministerial duty function, whichever word. Appoints. Am I through? Okay, there you go. So it's just A Bush. I think it used to be that back in the day anyway, at palatka-fl.gov.
that's fine.
Yeah. Many thanks. If you have any problems signing in, let me know, but it says it there. You'll just go to outlook.office.com, username
Yeah.
and password, and you'll be
All right.
super easy.
I think I can do that.
I'll be right back down.
Okay, thank you.
One of the board members here had asked for this, but I thought it might be of interest to everyone. This is, the city of Palatka contribution rates, that what they've contributed in the last 10 years.
Oh, okay,
Just,
for each of the plans.
yes.
Check your little sound thingy, make sure it's on the webcam.
I did not check that, no.
Just checking Friday. Not leaving, I'm right there, but you know what I mean, before we begin and
I have no idea where it is.
it's coming here.
Mm.
Remember, and then, oh, you're not muted, mute please.
Can you guys hear and see me?
Who's that?
Yes, Patrick, we can hear you.
Gotcha.
We're not quite started yet.
Okay. Okay,
Is, with Mr. Bird. Look to it, forward comments work.
Yeah.
Are you all ready to record?
Yes, we're ready to record.
Okay. If I could then, call the, meeting of the Board of Trustees of the General Employee Retirement Plan to order. It's, about 3:40. And I guess, we first need a roll call, Ms. Jill.
Yes, City Manager Don Holmes,
Here.
Alan Bush,
Here.
Tammy McCaskill, Jonathan Griffith,
Here.
Brett Dennis. He's absent, he's out of town.
Okay. All right. So, it looks like the first order of business then, unless you have something that you need for us to consider first. Jill would be to vote on reappointment of Brett Dennis to the board as a chairperson pro tem. Is
Yes,
that
Yes.
correct? So is there does anyone want to make a motion on that? So moved. Second. Any discussion? All in favor?
Aye.
Aye. Item 3 is approval of the minutes from the last meeting. Has everybody had an opportunity to read and review the minutes from the last meeting? I didn't ask you, Alan, if you were happy with what they said. I just asked if you had a chance to look at it. Yeah.
I move we accept the minutes as presented.
Alan, you second?
Second.
Any discussion of the minutes? Any corrections? Okay, all in favor? Aye. All right, sir. Foster and Foster evaluation report for fiscal year 22.
All right, you guys should have copies in front of you.
And for the record, who are you, sir?
I'm Patrick Donlin with Foster and Foster.
We just don't, I don't know if the screen will record, so very good. So would you
All
like?
right, so yeah, you guys. So I have good news on that page, which is actually surprising because most of my plans, the funding requirements went up this year because, every year as of October 1st, I'm on page 6, Joe, but
Yeah.
every year as of October 1st, we look at the assets in the pension plan and then we project out all the future retirement benefits to determine an appropriate funding requirement for the next year. And we always do the valuation 1 year ahead so that the city can budget. So the right-hand column there is the valuation done as of October 1, 2021. And that determined the funding requirements for the year we're in right now. And the left-hand column is a snapshot as of October 1, 2022. And that determines the funding requirements for next year. So you can see the total required contribution went from 39.6% of payroll to 36.8%. And the members contribute 6. So that means the bottom line city goes from 33.6% of payroll this year to 30.8% of payroll next year.
Mhm.
And really, the main reason for that is because the payroll went up. And some of our expenses, like the administrative expenses, but most importantly, that payment required to amortize the unfunded actuarial accrued liability, that like mortgage payment. Well, if you divide that by a larger payroll, then it's a smaller percentage. So that's the main reason the costs went down. But we'll get to that in a couple of minutes. But the bad news, of course, was the investment return. And you can see that on page 29. But our assumption, our expectation for investments is that we're going to earn 7.4% every year. And so if you look towards the bottom of the page, Jill has up there, but it says market value of assets as of 9/30/2021. Actually, scroll up a little, Jill, sorry. It's towards the top of the page, but it says that we had $22 million in the plan at the beginning of the year. And then we expected to earn 7.4%. So we expected to earn $1.6 million on those assets. And in reality, we lost 3.9 million because our actual return was negative 17.75%. So we missed the mark by $5.5 million. It was the worst year, in a long, long time for the investments, both on the equity side and the fixed income side. So then if you scroll up a little bit, Joe, to the upper left-hand corner, you know, we started a new smoothing technique a couple of years ago. And we basically said every year we're only going to recognize 1/5 of that gain or loss each year over a 5-year period. So that $5.5 million loss, we're going to only recognize 20% of that this year, 20% of it next year, and the next year, and the next year. But in 2021, we had a big gain of $2 million. So we're recognizing 20% of that gain each year. So when we smooth it out, our actuarial loss on investments was $579,000. But, you know, that negative $3.2 million loss this year, that's still going to hurt us next year and the year after for 4 more years. So I just want you guys to, be ready for, you know, some increases in funding requirements, all else being equal. Mitchell's probably going to tell you that you're off to a good start in fiscal 2023, which is great. Maybe that'll wipe out some of those losses that we had in 2022. But does anybody have any questions about the assets?
I have a question that's a little bit more generic, or general. And I realize it's early to try to project, but when you say we need to be ready to increase our funding for the next year, do you have, given the fact that we got a 20% gain of that gain from last year that we're realizing, and a 20% loss from the gain from the most recent year, we're realizing, yet any even range of the amount by which we need to be prepared to increase our contribution?
If you give me 1 second, I can figure it out. Actually, I can. So if you look, if you go more towards the top of the page, Jill, but we're deferring right now $3,201,000. That's what we're deferring of our losses. And next year it'll be $2,502,000. So we're gonna, if we get exactly what we're expected to get this year, 7.4%, then we're gonna recognize about $700,000 in losses. And that would increase the funding requirements about 1.5% of payroll. So, you know, all else being equal, you know, and this year you guys had salary, you know, payroll increases. So, you know, we don't know what's going to happen with the other issues for next year, but on the investment side alone, just recognizing more of these losses from this year, the costs will go up about 1.5% of payroll.
Thank you.
Sure. Well then, Jill, if you want to go to page 36. But that's the turnover, and that's part of the reason that your payroll went up this year. So at the beginning of the year, you had 80 active non-drop participants in the plan. You had 6 people in the drop, but you had 80 that were not in the drop. And then you had 1 person terminate vested. That's not eligible for retirement benefits yet. They're going to draw in the future. You had 1 member that terminated and they just hadn't yet gotten a refund of their contributions. And then you had 10 members terminate and take refunds of contributions. And then you had 2 people retire. And then you hired 21 new employees. So you started the year with 80 non-drop employees and you ended the year with 87 non-drop employees. So, you know, that was almost a 10% increase in the overall department. And that's partly what helped reduce the funding requirements as a percentage of payroll, like we talked about on page 6. And then at the bottom of the page, you did have 3 members pass away that were receiving benefits, 1 retiree and 2 beneficiaries. But one of the beneficiaries was 97 years old, and the other 2 were receiving about $500 a month. So you actually ended up with a slight actuarial loss on mortality. But that was fairly insignificant in this report. So then the worst page in the report is page 44. And this is the accounting of the plan. And for the accounting, the Governmental Accounting Standards Board wants all plans in the country to look the same. So if we use different smoothing, different actuaries use different smoothing for funding purposes. So for accounting, GASB, you can't use smoothing. So towards the bottom of the page, it has a net pension liability. And that just compares the asset value to the accrued liability. And that's the number that the city has to put on their balance sheet each year. So that went from $5.2 million last year to $9.2 million this year. And that was because of our, $3.5 million loss on our investments relative to the assumptions. That's why that went up from 5.2 million to 9.2 million. But I looked at last year's report, and 9/30/2020, it was 7.4 million. So, that's what you're going to have with this when you have gains or losses on the investments. You're going to have some volatility in this net pension liability, but there's nothing we can do about that.
So tell me if you would, if there's a practical consequence of that net pension liability increasing damn near 80%.
I don't think so, other than that, if the city wants to go out and get a bond or something, and then, people look at the overall financial position of the city, it looks a little bit worse this year than it did last year, because the value of the pension, the assets in the pension plan went down, relative to our assumptions. But I've rarely ever heard that coming into affect anything. But that, it is going to show on the city's balance sheet that they have a little more of a pension liability this year, net pension liability than they did last year. That answer the question?
It does.
So then I'll bring you all the way back to page 17. So this is the unfunded actuarial accrued liability, kind of like that same number we were just talking about, but this uses this investment return. And so last year, the unfunded actuarial accrued liability was $6,597,000. And we expected it to go to 5.8 million because, the city is making contributions every year to pay that down. And this year, it went down even more than normal that expected, because for one thing, the city makes contributions as a percentage of payroll, right? And so your payroll went up this year, remember? You hired new people and got salary increases. So that made the city contribution larger. And so, that helped pay down that unfunded actuarial accrued liability a little bit more. And then you can see that the actual in the end was $6,619,000 for the unfunded actuarial accrued liability. So there was an actuarial loss this year of $743,000. So $579,000 of that was that smoothed investment. It really was much worse than that, but with the smoothing, it was $579,000. And then salary increases on an individual basis were larger than expected when we compare individual members' salaries for fiscal 2021 to the individual members' salaries for fiscal 2022. They were higher in 2022, more than expected. So that makes the projected benefits higher than expected. So that increases the unfunded actuarial accrued liability. And then your turnover, those 12 people that terminated, was a little more than we expected. We expected about 10. And so that was a little bit of an actuarial gain. That's what the active decrements is there. And then inactive mortality was a loss of 97,000. So basically it was all mostly investment return loss and then a little bit from individual salary increases. But then if Jill goes to the previous page 16, 15 and 16 there show all those individual mortgage payments for that unfunded actuarial accrued liability. So if you go to the bottom, if you go to page 16, the total unfunded actuarial accrued liability now is 6.6 million. And we're making a payment of 966,000. And last year, the payment was 921,000. So the payment went up a little because we had that actuarial loss this year, but it went down some because we paid money towards that unfunded. But then if you go to page 13, no, 12, I guess, I'm sorry, page 12. So the third line down on page 12 is the payment required to amortize the unfunded actuarial accrued liability. Well, the dollar amount went up a little bit, just a little bit, from 921 to 966, but the payroll went up. So last year it was 26.9% of payroll, and this year it's 24.1% of payroll. And then your administrative expenses on the second line, that went down too because your payroll went up. Your expenses probably stayed about the same, but your payroll went up. And then your normal cost always stays about the same. That went from 11.4 to 11.6. So you add those three pieces and that gets you that total funding requirement that went down a little bit for next year. So those were kind of the highlights of the valuation report that I wanted to go over, but I'd be happy to answer any questions anyone has.
So for those of us who don't live, feedback, I'm sorry. Is it possible for you to state, or is it not your position to state something in layman's terms, they don't help our pension folks?
You said in layman's terms, and then I didn't hear what you said after that.
Back in.
I'm sorry. I'm sorry, we're getting feedback here. We were. I was asking about in layman's terms, if you could just tell us how we sort of rate comparatively in terms of the health of our program. Are we in a good zone, bad zone, danger zone?
Well, I mean, yeah, I can do that. Let me look at something on the computer. Hold on a second.
Sure.
But if you go to page 10.
10.
1010.
Okay. Okay.
The bottom there, it says funded ratio. And that's where plans try to be in the 80 to 100% range. And so, you know, you had improvement this year, even with the actuarial loss. So last year you were 75.6%, and this year you're 76.1%. And so remember on the other page that we have a normal cost and administrative expenses, and then we're making a payment each year to pay down that unfunded actuarial accrued liability. And that payment, you know, is going to gradually improve that funded ratio, ultimately to 100%. And so the health of the plan, you're probably a little bit lower than the average plan in Florida right now. The average plan is about 85% funded ratio, but you're not out of line with any other plans. And then, you know, it's never a problem as long as the city keeps making their required contribution. That's why we do this valuation report every year. We look at the assets and the liabilities and freshen up the funding requirements. And actually, you know, because you contributed more than you needed to because of the way the funding works, and because your payroll went up, you know, you can actually put in less next year as a percentage of payroll. But you're always sound on an actuarial basis. Does that make sense?
It does. So is it possible that when we, at our next meeting, that you could provide those who are on the board and with a bit of a historical perspective as far as where our funding ratio or funded ratio has been over the years? So you're showing 21 was 75.6, 22, 76.1. Just out of curiosity, I always like to have an idea of where it's been over the last 10 years.
Actually, Jonathan had requested that, and there's a copy of it on your desk. That's okay. It wasn't a part of the agenda package, but since he had requested it, I wanted to make sure that you all had it.
So you guys are making the recommendation on what our contribution as a percentage of payroll should be. So what's the model? At what point are we going to have this unfunded actuarial accrued liability down to zero? And we just lost Patrick.
Well, this isn't what I asked for anyway.
All right. That is the general employees, what the city has contributed over the last 10 years.
I understand. That's not what I asked for. I'd asked for the ratio, which is down on the bottom of page 10. 21, it was 75.6. The 76.1 is this year, 2022. My question was, where has our funded ratio been over the last 10 years?
It'd be helpful to see it side by side with the contribution rate, so we can see how we're trending based upon percent or same contribution.
That's what I was looking for. You know, how are we trending with this? If 10 years ago we were at 90% and now we're at 76%, that's not such a special thing. And conversely, if 10 years ago we were at 65%, then, you know, that's a different ballgame. But those kinds of things are more meaningful to me than a lot of this other detail that, quite frankly, I know, and I appreciate the fact that, you know, that someone else is pointing this out, but from perspective of someone who looked at this once a quarter, it's a lot more meaningful for me to see trends. And what he just said was helpful to me. He said that most programs in Florida are at 85%. We're at 76, so we're below.
Patrick's not here, but in their presentation, it's page 18. It's not numbered, but just before 19. This is going back to 2013, your funded ratio.
Right.
It looks like it doesn't have the numbers on there, but it looks like it's in the 70 to 80% range over that entire period. That's helpful.
Yep, it looked like it was higher in 15 than now. and higher than 14 than now, or than 2022, but except for 14 and 15, it looks like we're now about
Doesn't look like we're gaining any ground, to be honest with you.
double lot.
Yeah.
So, okay, well, that's something for y'all to consider next time. I mean,
Yeah, can you guys hear me and see me now?
we can now. I guess it's concerning to me that we're.
Yeah,
So I guess that it's concerning
it's
to me.
concerning to you.
uh,
Yeah, I can send you something for your next meeting about the funded status over the last 10 years.
Well, sir, say your name again, please.
Mitchell,
Mitchell pointed out to us a page that's already in the packet that shows a bar graph of our, what appears to be our funding progress. And as I was saying, that sort of trend and relative position information is more, I guess, helpful to me than the raw numbers. And I'm not discounting the significance of the raw numbers to folks that we deal with them every day, but for me, the two things that stand out to me are, you said most plans in Florida are at 85%, and we're at the 76% number. And also, when you look at our performance over the last, since 13, we hover right around the same range. We're not making progress in getting to an 85% number. And I guess from my personal perspective, and this may be an uninformed perspective, or maybe it's an unsophisticated perspective, but that's troubling to me a little bit that we, aren't in the 85% range and we're not making any progress towards getting there. So that's just a comment.
Well, Joe, can you go to page 13, Joe? And scroll down to where you get the investment return information. But part of the reason that you haven't gained any ground is because you've changed your assumptions. So I believe you were at 8% assumption 10 years ago, as far as what we expected to earn on our investments. And the board has gradually reduced that assumption. And so if you make the assumption that you're going to earn 8% per year, then you're going to look better on a funded ratio. You're going to say you're not very far behind where you'd like to be. But if you change that assumption to 7.4, now your funded rate is going to go down. I'm sorry, could you guys hear me?
Yep, we hear you.
So I thought that this bar graph though was reflecting actual experience, not projected position. And if that's the case, then I don't understand why a projected or an assumed investment return rate would impact upon previous funding ratios. I would have just, again, maybe unsophisticated on my part, but I would have thought that your actual experience when we're looking backwards would be what you'd be utilizing as a criteria in deciding what our funding ratio had been for the previous year. Does that not make sense?
yeah, I think I can add. Patrick,
Well, if you look at page 10, if you look at so the bottom of that page has the accrued liability. You see that? And so the total accrued liability says 27,733,000.
Right.
And then And so to get the funded ratio, you compare that liability to your actuarial value of assets. And that actuarial value of assets is 21,114,000. So the difference is that unfunded actuarial accrued liability there of 6.6 million. But that ratio of 76.1% is the $21 million in assets divided by the $27 million in accrued liability. That's how you get 76.1%.
Okay, but my question is, isn't that actuarial value?
And if you look at that, but so if you look at the asset value, that's true. That's just the asset value with the smoothing. But that total actuarial accrued liability, the way we calculate that is we project the benefits people are going to make, over the next 50 years, their benefit payments, and we discount them with that interest rate.
Okay,
So if you have an 8% assumed rate, then that 27 million is going to be 22 million or something.
okay, I appreciate it.
And so, okay.
I appreciate that explanation.
But yeah, I can do a little history for you for next meeting that tells, where we were 10 years ago, where we are now, and basically how we got there. Some of it is experience, some of it is assumption changes. So you have a better idea of why we are where we are.
Okay. Thank you for that explanation. Does anybody else have any questions? I didn't mean to monologue questioning.
I don't know who this question needs to be directed to, but I'm just curious, if we assume 0% asset return this year, what would the percentage of payroll increase need to be?
Well, we don't make an assumption by year. It's what we expect every year going forward. So, but actually, if we actually get a 0% return, is that what you mean, or?
Just saying that our assets on the books right now, we didn't have any return. We're assuming 7.4. If you assume 0%, what would the percentage of payroll contribution increase by?
I think there's a semantic. He's saying your experience is actually 0%, even though you're assuming 7.4.
Right. I'm just looking at the asset page to give me an idea. But I'll look at it while you guys are talking and I'll get back to you.
Okay, so any other questions? If not, we'll go to the BCA report.
Would you like to make a motion to accept this report?
So moved.
Alan, you want a second?
Second.
Any more discussion? All in favor? Next item is the BCA report.
All right. Well, thank you for having me. Again, I'm Mitchell Brennan. I work with Burgess, and unfortunately he couldn't make it today. Just quickly before I start, I don't know if this will be helpful, but in Patrick's report for Foster and Foster, page 26, they do have a few of the percentages for the funded status for 2012, 17, 21, and 22. So if you need actual numbers to that bar chart, there's a few numbers there.
Thank you.
And you are fortunately trending, it looks a little bit better there, but again, to your point, not making much ground. For my report, obviously 2022 was quite an outlier of a year for both equity markets and fixed income markets. So I've actually provided an additional handout for review, just to give a little further context into what we saw in the markets and some of our views going forward into 2023. So on page 2, you can see here, this is looking at the Bloomberg US aggregate, formerly known as the Barclays US aggregate. So this is the broad bond market index that we utilize when we compare our core fixed income allocations. And so this goes back to the inception of the index, 1976, and you can see historically prior to last year, we've only seen losses in fixed income and bond markets 4 other times, the worst of which was down 3%. Now, if you pan all the way to the far right, you'll see that for 2022, we had a historically bad year in fixed income, down 13%. Based on the significant increase that we saw in rates from the Fed boosting up rates in order to combat inflation. And so as rates rise, the market value of bonds goes down. And so that's why we saw those historically bad returns in fixed income last year. Page 3, this highlights those Fed actions. And so that gray line that you see kind of staircasing up and down, on the far right, you can see the pretty much vertical line up for 2022 that accounts for 7 rate hikes throughout the year, raising the Fed funds rate from a range of 0 to 0.25 all the way up to a range of 4.25% to 4.5%. We've seen an additional rate hike of another 0.25% so far in 2023. And so really what markets are looking for right now is what is going to be the terminal rate? Where will the Fed stop and then potentially pivot and start cutting rates should they throw us into a recession? And so as of right now, this was as of the middle of January, that expected terminal rate was about 5.1%. With the most recent CPI data that came in a little bit hotter than expected for January, that's actually bumped up to about 5.3%. And so that would mean another 2 or 3 quarter basis point moves from here through the rest of the year. And again, the Fed is fighting their 2 mandates are price stability and full employment. So from a price stability standpoint, that's bringing inflation down to 2%. The January read was 6.4%. So they still have quite a ways to go. It's come down significantly from over 9% in the middle of last year. But again, they have quite a ways to go. And so until they can get it below the Fed's funds rate, they'll continue to raise that rate until they meet inflation where it's at. From a full employment standpoint, the reason they're able to do this is we're significantly below the unemployment level that they look at. So they look at about 4% as fully employed, an unemployment level of 4%. We're about 3.4% right now, which is one of the strongest labor markets historically we've ever seen. The most recent jobs number came out. There was an expectation that we would add, I believe, about 170,000 jobs. It came in over 500,000. So despite the headwinds that we're seeing in the economy, there's still significant strength in the labor market, which is again kind of adding to the stickiness of inflation. Page 4, this just highlights again the significant move that we saw in interest rates. So this is the Treasury yield curve from the 3-month to the 30-year. So you can see on the short end of the curve over a 4.5% move in interest rates from essentially 0 to 0.2%, all the way up to on the 6-month and 3-month side, 4.76% at the end of 2022. Even longer term 30-year treasuries went from just below 2% to upwards of 4% at the end of the year. And so on page 5, this highlights really what we saw through the entire year for the different areas of the bond market that we look at. TIPS and Treasury inflation protected securities, something you would expect to do well in an inflationary environment. You can see in the middle of the page, TIPS right there, they're down nearly 12% for the year. 30-year treasuries down over 33%. So significant downside in fixed income for the 2022 year. The good news is, however, going forward, it's beneficial to have these higher yields. So the first column you'll see next to each one of those different bond categories is the yield as of 12/31. And so we can see for the aggregate, it was at 4.7% to end the year. Investment grade bonds at 5.4% and high yield bonds almost 9%. So going forward, where we've historically had to continue to move more money into equities and riskier parts of the market to achieve that assumption rate of what's now 7.4%, but was 8% just over the past decade, where we've had to move more assets into a riskier part of the market to generate what we weren't getting from bonds when they were only yielding 1-2%. Now we can actually start to transition to a more conservative portfolio where again, we're yielding 5, 6, 7% from bonds. And we're seeing very favorable risk return within bonds. So on the right side, this looks at expected returns, should we see another 1% rise or fall in bonds. And so you can see, especially on the shorter end of the curve, really no downside right now in bonds should we just see another 1% rise. But should the Fed throw us into a recession and have to pivot and start cutting rates, there's some significant reward, whether it's 6% on short term, 10% on 10-year treasury. So our core bond portfolio falls right in between that 5 and 10-year kind of duration or maturity. And so we would expect, again, if rates are flat, you'd be yielding about 4 or 5% in bonds. If rates come down, you could see upwards of 10% returns. But again, should rates rise, we've already suffered really the extent of it last year. We'd likely be flat, maybe slightly positive should we see another 1% rise in fixed income this year. Any questions on that? And then just quickly, we can flip over to page 7. So looking forward, one of the areas that we think is going to stand out this year is international, specifically the investment we use here, American Funds Euro Pacific. It has about a 20% allocation to emerging markets. And so if you look currently, emerging markets are trading at a huge discount compared to the valuations of the US. So if you look at MSCI EM, that's emerging markets, whether it's their PE ratios or price to earnings or price to cash flow, it's significantly discounted to what you see in the first column there, the S&P 500. On the next page, and because we've seen emerging markets beat up for the past 3 years, really because of the strong dollar this past year, and then the zero COVID policy in China for the past 3 years, those are starting to subside. The dollar is weakened as other international governments have started to increase rates domestically. And the zero COVID policy in China has started to pull back a little bit. We think emerging markets are posed to perform pretty strongly this year. Additionally, if you go to page 9, where we saw, again, significant weakness in their currency. So page 9 shows all the different Asian and emerging market countries. Almost all of them were down anywhere from 5 to 10% in terms of their currency last year. We've already started to see that rebound. And on page 10, additionally, along with the stronger currency, these export-based economies should also benefit from the huge increase we saw in commodities across the board. So with the exception of coffee, essentially every major commodity globally is up significantly over the past 12 months. And so export-based economies should benefit from these higher commodity prices now that their currencies are rebounding and strengthening. So again, when we look at what's in your portfolio, if we go to page 14, the American Funds Euro Pacific Growth Fund, again, historically, these are rolling 5-year periods. It's historically outperformed its benchmark 90% of the time on rolling 5-year periods. Page 15 highlights its portfolio. Again, about 21% in emerging markets, an additional 9% in Asia Pacific developed markets. And so we think going forward, they're going to be a huge beneficiary of those tailwinds that I mentioned. Stronger Asian currencies, stronger commodity-based export economies in those Asian countries. And so along with the significant discount valuations, we'd expect, we've seen 15 years really of the US outperforming international from an equity standpoint. We think that may change this year. Any questions on that? All right. And then the one recommendation that we have today has to do with Voya's Large Cap Growth Fund. So if you look at page 17, at the end of 2022, the 2 long-term co-PMs of the portfolio, Michael Peacock and Jeff Bianchi, they both left the firm. And so they had added a new PM at the midpoint of last year. But unfortunately, the track record of the fund is entirely attributed to those 2 PMs who are no longer with Voya. That, along with really a struggle the past 3 years, starting in March of 2020. You can see here the rankings. This views over 1,000 different large cap growth investments, whether it's index funds or actively managed funds. They've only ranked in the top 73rd percentile over the past 3 years. And compared to the Russell 1000 Growth Index, they performed about half of what the Russell 1000 Growth has done over the past 3 years. So with that, our recommendation is to start liquidating Voya large cap growth. And we would start with one half and then continue to evaluate their performance at each coming quarterly meeting. We would do it in 2 trades. Right now, based on current market values that I've pulled from yesterday's market close, there's a little over 2.4 million in Voya. So we would just start with an even 1.2 million, and we would sell 600,000 at a time to get to that 1.2 million. So our recommendation is to move that money into the Fidelity Large Cap Growth Index Fund. It tracks the Russell 1000 growth. So the performance you see at the bottom of page 17, that's the exact performance that you would have received from the Fidelity Large Cap Growth Index Fund. Furthermore, the next page, that shows the consistency of both funds. And so again, if you look at, really starting in 2020, that's when we started to see a decline in Voya. But historically, the Russell 1000 Growth Index has just been a very tough benchmark to beat for active managers. It's performed in the top 30th percentile or better for these rolling 5-year periods going all the way back to December of 2007. So that encompasses the great financial crisis of 07 to 09, also the drawdown in March of 2020 from the beginning of the pandemic. So whether it's to the upside or downside, the benchmark itself has just been very tough to beat. And so our recommendation is to start by moving half of the Voya large cap growth to an index fund that tracks the Russell 1000 growth. And that fund is on page 19. So you can see the historical performance of it, again, right in line with the Russell 1000 growth. And from a cost standpoint, significant cost savings. The expense ratio there at the very bottom middle of the page is 0.035%, so 3.5 basis points. So with that, I'll open it up to any questions or any discussions you'd like to have about that recommendation.
You made some comments about bonds. Didn't we transition a percentage of our holdings from bonds to real estate last time?
Yes.
So you're gonna be coming back to us to reallocate to bonds?
Not right now. So we're on target with our bond allocation. And we can, if you open up the report, I can take you to that page. So page 13, and this is actually a little bit skewed. So one of the things that you'll see here is at the end of the year, so this is on page 13 of our report, there was 21% in cash and only 9% in fixed income. What happened without notification to us or your custodian, Vertus Sykes short-term bond fund was completely liquidated. So Allianz acquired Vertus last year and has started liquidating funds with smaller than what they would like to see assets under management. And so on December 16th, they actually liquidated the Vertus Sykes short-term bond fund, moved it to cash, and didn't notify us as your consultant or the custodian. So we were unaware of that until we started looking in January at a normal cash rebalance. We saw the significant amount of cash. Fortunately, we ran a test to see if there were any opportunity costs in terms of not being invested and being in cash. And because rates have increased, we're actually making money in cash. You actually made a little bit in cash compared to what you would have made in another short-term bond fund or just your the current Sykes total return bond fund that we're invested in. So there was no damages there, fortunately. But because of that, we did rebalance in January. And so you can see on page 5, the last bullet on page 5, that actually highlights the rebalancing we did. And then to your point, we did raise some money and we funded 7% to private real estate after September. So in October was when they actually called the capital last year.
So with this rebalancing in January, what's the percentage in cash and fixed income now?
Yeah, so as of yesterday's market close, you're currently at about 1% in cash, 177,000. You're currently at 37.6% domestic equity, 6.4% infrastructure, 8.2% convertibles, 15% international, 5% REITs, 6.8% private real estate, and 20.1% fixed income.
And Voya, is that international equity?
It's large cap growth U.S. equity.
Okay,
Yes.
so do you want to repeat the recommendation?
Yes, so the recommendation is to sell half of the Voya large cap growth fund to reinvest in the Fidelity large cap growth index fund and do that in 2 steps. So 600,000 and then another 600,000. The markets are quite volatile, so we want to dollar cost average the trades instead of doing it all at once.
And what would the targeted percentages for domestic and international be at that point?
Yeah, so they remain the same. So all you'd be doing is moving from one large cap growth investment to another large cap growth investment. So it wouldn't change the actual allocation at all, just changing from one large cap growth fund to another.
I'll make a motion.
Okay. So. Okay, any further discussion? If not, then all in favor?
Aye.
Any opposed? Sounds like that was approved.
All right, thank you. And then we can actually stay on page 5 of our report. And so we did have a strong quarter. We're at 919,000 to finish 2022, and more importantly, start our new fiscal year, which was 5.2%. Slightly underperformed the benchmark because we were at the time underweight domestic equities and international equities. Your best performers for the quarter were your small cap value manager of 14.3%. Your international fund, your Pacific, was up nearly 14%. And then the Virtus Ceradex large cap value fund was up 13.5%. On a 1-year basis, down 3.4 million or 14.9%. And you were led by cash was up 1.4%. So again, one of the additional benefits of rising interest rates is we're actually making money in cash right now. I would expect that to go up even more. Most money market funds are up north of 3.5 to 4%. So going forward, assuming we don't see rates get cut, you can expect about 3 to 4% in cash going forward. The other 2 funds that held up best in a down market were Conan Steers Global Infrastructure was only down 4%. And then your Ceradex Small Cap Value Fund was down just shy of 9%. If we look out longer term for the past 5 years, you've earned 3.3 million or 4.2%, which outperformed your strategic model over that period on it. And if we flip to page 9, you can see the numbers I referenced here. As of yesterday's market close, so we finished December 31st at 18,799,000. We are now up to 19,277,000. So an increase in the current quarter to date. So from January 1 through yesterday of about 477,000. So again, a good start to the new fiscal year, which should hopefully mitigate some of the losses that we saw in 2022. The last column on that page, I'll also highlight over the past 10 years, generated 9.7 million in investment gains to offset about 7.4 million in distributions from the plan over that time. And you've had an annualized return net of investment fees of about 5.6%. The next page I'll go to, page 16, and I will stop here. But again, the only recommendation is to trim some of that Voya and move to the index fund, which again has been a very strong performer. And so we think going forward, that's going to be a better allocation versus the Voya large cap growth fund. And next quarter, Burgess will continue to evaluate that. As we sit right now, Voya is up 4.6% year to date. The index fund is up 7.3%. So again, we're already starting to see it continue to outperform. So I would expect Voya that we would continue to recommend liquidating. But again, we want to do it in small steps because the market has been quite volatile and we don't want to be on the wrong side of the trade any one given day. Other than that, everything in the portfolio is positive with the exception of the Cohen and Steers Global Infrastructure Fund. It's flat year to date. And then private real estate, unfortunately, is likely down currently quarter to date. It was down last quarter. We saw a revaluation of properties in the fourth quarter, mainly due to office vacancy ticking up. So nationally, office vacancy is about 20%. American Realty is a little bit better than that. Their occupancy is about 83% in office, and on a total portfolio basis, their occupancy is about 92%. But again, unfortunately, in such a tight labor market, employees still have the leverage over employers to continue to work from home. And so as leases have started to roll over, this was the first time, even throughout the pandemic, that we started to see leasing renewals start to tick down and that occupancy stay around that 80% mark. So we would expect some chop going forward through the rest of the year for private real estate, but longer term, if you look on page 17, we still expect strong returns in private real estate over the long term, somewhere in the 6 to 8% range, which again is right in line with our assumption rate of 7.4%. So we may just see some volatility, unfortunately, for the next couple quarters, but longer term, we still expect income in the 4% range, and then long-term appreciation in that 2 to 4% range. So with that, I will conclude my report. I've taken up enough of your time and open it up for any questions or anything else you'd like to discuss.
Anybody have anything else they want to ask or talk about?
Got nothing.
If not, then can I have a motion to accept the report?
So moved.
Any further discussion? If not, all in favor?
Aye.
Aye. All right, thank you.
Thank you.
Okay, next would be the Faulkner, Kaufman, Jensen, Levinson report. Ms. Parrish, are you with us?
Hi, Lindsay Garber is with you. I'm filling in for Anna. She had a conflict, but I'm an attorney at the firm.
Okay, thank you.
It's nice to meet you all. I'm going to just move through this relatively quickly. If it's okay with you guys, I'd like to do item B first, the addendum, just I think it'll be a quicker discussion. So at the last meeting, we asked Anna to draft this addendum, which had to do with the change in Delaware law that was exculpating corporate officers from breaches of duty of care. So she drafted this addendum, which will be added to your IPS, just saying if there's any proxy votings on this issue that you are directing your individual managers to vote no. I believe that Burgess's office has seen this and she can work with their team in communicating this with your individual managers. And if you guys don't have any questions on it, well, let me know if you have questions. If not, we'd have to vote to approve it.
Anyone have a question? Do you have a motion?
So moved.
Any discussion? All in favor?
Aye.
Any opposed? Okay.
Okay, great. So she'll work with Burgess on that. The second item is deals with internal controls. So this is both an FYI and recommendations. In November of last year, we had a South Florida pension fund administrator who was arrested for theft of pension fund assets. He stole over $3 million. He did this mainly by death checks. So typically when someone dies, the administrator will turn off the pension check for that person. In this case, he was not reporting the deaths, and he was changing the direct deposit information to accounts that he controlled. So he did this for about 9 years, was able to steal $3 million. The board has criminal. I'm sorry. Is there a question?
I said, how many million? And Jonathan told me it was 3.
It was 3 million. They are suing for 9 million because under Florida, you can get triple damages. We have no idea if we'll see any of that money back, but we're doing what we can. So in response to this, we've drafted this internal controls policy memo, just recommendations to the board of how we think you can guard against fraud in this particular way as other ways. The main recommendation is separating out duties, right, to ensure that people are checking each other. So in this case, it was a one-man shop and he had control over payroll, writing the checks, signing the checks, and then making sure that the accounts matched up. So we suggest separating out duties. We were, are suggesting periodic reviews, and we gave a list of things that we think you all should review with your members. We are implementing layers of security controls, which really goes around dual signatures, right? So having 2 signatures for all your transactions, for your benefit approvals, your return of contributions. We're suggesting that at least one trustee is a dual signature, but we know that that's not always possible for small plans. So, you could have an administrator also act as an authorized signer.
So how long did you say this person was able to perpetrate that scheme?
It was over 9 years.
So I have to ask the question. There's nothing in the audit process over 9 years that would have produced a red flag?
Yes, so that we have some suggestions in auditors. It's for number 6. Our office is personally looking at what auditors should have seen and not seen, and that's a separate discussion of whether the board's going to pursue anything against the auditor. But the auditor, to our knowledge, was not checking over these death checks, right, to confirm that someone actually died. So we are suggesting, not this audit, but next year's audit, that within the engagement letter, you guys ask the auditor to perform death checks of folks that are having accounts. We also are suggesting that the auditor confirm the account numbers, right? And look at the different account numbers to make sure there's not duplicate accounts. So yes, we believe the auditor should have found this.
Are you in a position to pass these recommendations on to our auditors, Jill?
Yes.
Okay.
And we do a yearly death check on all retirees, where they have to go to a notary and sign in front of the notary that they're still alive. It's called the Alive and Well.
Yeah.
That's going on for about 4 years now.
Cool.
But as I told the police pension board, there was a member who died and the family didn't notify anyone for 4 months, and they got 4 months worth of pension checks. The family worked with us to get the money back to us for the police pension. The banks themselves have subscription-based services to
Great.
file death checks. But doesn't always work. They didn't find that one. And they have already told me that someone had asked for the Social Security Administration, when I know for a fact they're alive and well. Contacted them and had them re-sign. So nothing is infallible.
No, well, understand that. Okay, I just wondered if you would pass that on to our auditor, but it sounds like that you're ahead of that. So thank you.
And I'm not sure if you guys have an internal controls policy written. We have one drafted because of this. So I'm happy to let Anna know if that's something you guys are interested in seeing. It covers a whole range of these topics within this memo.
I'd like to see it. I'm not sure, as you indicated a minute ago, that we're a small pension plan, and I know that historically, when it comes to separation of duties, that can be problematic for us.
Yeah.
But we'd like to see
Okay. Okay, perfect. I will let her know and we can send that over to you.
Thank you.
But yeah, these are just suggestions, and we say in the memo that nothing's going to be guaranteed. It's just some things you can do to help guard it. And we've also talked with other plans about them subscribing to a subscription-based death check. And I know it's very expensive, but it could be something that you do with the other pension plans, come together and have one contract for it. We're happy to look into that too, if that's of interest.
Okay, thank you.
Okay, that's all from me.
Okay.
So we need to accept these recommended changes.
You don't. It's just really just an FYI for you all. If there's anything in particular that you're interested in, we can draft a policy for that, but I'll have Anna send you guys the master policy.
I'd like to look at them before we accept them or incorporate them.
Yep, sounds good.
Okay, willing to accept the report?
So moved.
Second,
But
any more discussion, all in favor? Aye. Okay, thank you.
Of course.
Quick expenditures, Jill,
Yep,
what page are they on?
they look like this.
They look like that.
Yep. There were the second thing in the packet, or no, actually, one of the final things in the package.
Do something on the last page of the packet.
Yeah, they look like that.
Yeah, this. Anybody have any question about them? Okay, if not, let's accept the report.
so moved. Second.
Any discussion, all in favor? Public comment. I don't see a lot of public here. Going once, twice,
Mr. Chair,
yes?
well, I
Yes,
just had a couple comments because I was looking at things while you guys were talking. I don't know if you can give me a couple extra minutes at the end.
sure. Take them now.
Well, hey, Jill, is there any way, can I try to share my screen?
Yes, of course. Go
I
ahead.
think it says that you're sharing it right now.
Okay, try now and
Yeah, it
pause.
says I cannot start.
Try it now.
Looks like you were successful.
All right, this page, I'm not going to show you much, but I did the calculation of if we get a 0% return this year, the costs are going to go up about 0.7% of payroll. You know, because we smooth that out, it would be a loss of 1.3 million for the 1 year, but you know, we only recognize 20% of that and then amortize it. So that was the one trustee's question. And then, but to answer your question about the funded ratio, I don't know if you guys can see this or not, but I had done a listing for Jill on Friday of the general employees contribution rates for the last 10 years or so.
Yeah, we
And
have,
so remember in this report, what'd you say?
we have that. She provided that to us.
Okay, so if you can see that that's what I have here on the left-hand side of the screen. It shows the city contribution rate every year. But then now I added a column for funded ratio because that's what you were concerned more about. You know, that's what you were asking about.
Exactly.
And so it's 76.1% now. It was 79.1% in the 10-114 valuation. And so, you know, I looked at what it did each year. So it went from 79.1 to 81.1. And that was because we had good investment return and favorable salary increases. And then I looked at, we used to use a 4-year smoothing of the assets. We would just basically take a rolling 4-year average return. So for that year, the rolling 4-year average was 8.9%. But then the next year, the 4-year average dropped to 6.8. And the next year was 6.3. The next year was 5.4. next year 7.1, next year 6.65. So for those 5 years, you know, our investment returns on average were, you know, in the range of 6 to 7%, which was less than our assumption, which if you look over here, we changed from 8% to 7.9 and then 7.9 to 7.8. So anyway, I guess the long and the short of it is, like, if you go in 2018, if we didn't make the assumption changes, we would have went from 81.1% to 79.6, but the assumption change brought it to 76.1. So a lot of the reason that the funded ratio is relatively the same now is because of those assumption changes. But I can do a little more easy to read presentation for you guys for your next meeting.
Thank you very much. I appreciate you going back and doing that on short notice as you did. So thank you very much.
All right, no problem. That's all I have.
Okay, last item is other business, Form 1 email address for board members.
Yes, Florida statute has changed so that all board members have to have a municipal email address. And we've already discussed it with Mr. Bush and got him the paperwork to get that done.
Okay. All right, and is there anything else coming before the board?
Yes, there is. There's one thing on our next board meeting in June. We have a conflict with building and zoning. They need the room at 4 o'clock. In
Tell you
order,
what, Jill, I give you permission to put it whenever you want to.
all right. So we're gonna just, instead of 3:30, we're gonna be here at 2.
Cool.
Okay, and I'll let everyone know.
And you all need to replace me, right?
Yeah, I know. Yeah,
So,
and your position is city manager. It has to be the city manager.
maybe it will be.
I know.
All right. Then there's nothing further to come before the board. We can stand adjourned.
There you go.
Bye,
Sorry.
guys.
You met the applicants for city manager.
Yes.
What do you think of?
Um,
Having fun, Joe.
Yeah, fun.
Excited stuff.